Good evening, everybody. Hey, Keith Pitch here, Mortgage from a Treehouse. It is that time again, Thursday night, 7 p.m. on the button. I was just thinking here before I went live, I'm like, wow, maybe we need like a theme song. And I'm trying to think of a theme song that would be appropriate for Mortgage from a Treehouse. So if any of you guys have an idea of a theme song, let me know. I'm gonna put the question out there. What should our theme song be? Boom, out there to the world. Anyway, well, hey, let's jump right into it. Another beautiful day in the neighborhood here in the beautiful Pacific Northwest. We had sun, warmth in the air. I mean, you walked outside today and it was warm, and that was nice. You could feel it inside. So awesome. So spring is upon us, and we're talking about non-qualified mortgages today, and it's a fun show. I want to geek out a little bit today because we're going to go a little deeper, right? We hear all these different headlines about Fannie Mae, Freddie Mac, FHA, VA, blah, blah, blah. But there's a whole nother world of mortgages out there that I want to just kind of introduce people to, our real estate agents, our consumer public, our past clients. There's a whole array of mortgages out there to help people that can't traditionally qualify, and that's what a non-QM mortgage is. So we're going to jump into the conversation on what a non-qualified mortgage is. And a non-qualified mortgage is not a qualified mortgage. So as the mortgage meltdown happened, you may or may not recall, 2008 wasn't a great year. And so what came of that was legislation and definitions of what mortgage lenders had to do, right? So we had to go out there and make non-qualified mortgages that were going to be out there, we had to make qualified mortgages that were going to be out there and securitized in different trusts and REITs and mutual fund companies and all that stuff. So qualified mortgages versus non-qualified mortgages, right? Qualified mortgages have more stable features, right? They don't have balloon payments. They don't have negative amortization. Again, throwing it back to 2007, going into that, we had adjustable rate mortgages. We had negative amortization arms. So you would pay a very small teaser rate, introductory rate, but you weren't paying enough mortgage payment to pay for the interest that was actually accruing on your mortgage. So you would just tack that on to your principal balance, and it would just get bigger. Your mortgage would get bigger, right? So there's no interest-only features. There were a handful of interest-only deals done. I don't remember the number right off the top of my head, but it was pretty close to the majority of loans being done, I think in 2005, 2006 time, actually were interest-only, right? So there was no principal being paid on those. So after the mortgage meltdown, qualified mortgages say, hey, you can't have any of these unstable features of your loan. It's got to be a fixed rate. It's got to be fixed rate. It can't have prepayment penalties. It can't be crazy negative amortization arms, and it has to meet the threshold of the ability to repay. So this is a spot. We have income, assets, credit, and the collateral. The income is where a lot of people just throw up their hand and say, oh, I'm this, I'm that. I don't qualify because we don't fit in the box. So the ability to repay rule says that we, the mortgage lenders, have to have a very concrete determination and reasonably good faith determination that your income is stable and that it's going to continue, right? So that was a result of, anybody want to throw it into the chat box? Like, why do we need this ability to repay? Anybody remember the stated income loan? They were called the liar loan, right? Hey, I work at XYZ company and I make $20,000 a month. Oh, great. Here you go. Here's your loan. That's how it used to be back in the day. So out of this came the ability to repay. And it's great that we have this standard of practice that we are bona fide getting these people in a mortgage that we know that they can actually repay. Before the mortgage meltdown and before ability to repay, we had a lot of those stated loans and all that, and there was no real effort to understand whether or not they could repay the mortgage debt that they were encumbering themselves with. And that got into a big mess, and we all got to live through it. So fast forward to today, we have the ability to repay. So what does that look like? Fannie Mae, Freddie Mac, I call these my vanilla lending lenders, right? So they want traditional pay stubs. They want W-2s. They want their tax returns for the last 2 years to make sure that your income is there. It's stable. You've been in that same line of work for 2 years. There's no huge losses on your tax returns, and all that good stuff. And so what happened as a result of this is we got a lot of great integrity in the mortgage market today, right? What you see now in the world of the multiple offer situations and the bubble that people keep talking about, and I'm going to address it next week. That just a little preview to next week. I'm going to talk about the power of real estate. It is an amazing, amazing financial tool, and we're going to talk about the power of real estate and why we're not in a bubble. But one of the main reasons why we're not in a bubble right now, folks, is because we actually have integrity in our lending, right? If you get a bunch of people that shouldn't be in housing already into housing, you're artificially inflating the number. Now we have people that are in housing. They've gone through pay stubs. They've gone through the complete gauntlet of going through income, assets, credit, and collateral through the mortgage process. But there was an unintended consequence of this. And what I'm speaking to is our self-employed individuals. What I'm speaking to is folks that maybe don't have a traditional income because they have assets, right? So, hey, I'm well off. I did great for myself. I have a bunch of assets, but I can't get a mortgage loan because I don't have a traditional job. And the other one is the investor. So we're going to talk about those three tonight. That's the non-QM portion that I want to talk about that is super powerful for those of you that are self-employed, those of you that have assets but not a traditional job that you can document in a traditional fashion, and those folks that are real estate investors. There's great options for you out there in the market to not sit on the sidelines, to jump back into the game, to be part of the real estate that is going on in Washington and in this fine nation that we find ourselves in. So without any further ado, let's jump into it. So pay stubs, W-2s, and tax returns, Fannie Mae, Freddie Mac, vanilla, can be morphed into and verified with bank statement loans. They can be verified with asset accounts and asset depletion loans. And then finally, rent roll. And that's my favorite. I saved my favorite for the last, but it's super, super exciting to talk about rent rolls and debt service coverage ratio. So these are all documentation abilities to repay, right? We're not going back to 2008, and you guys shouldn't be afraid of these non-qualified mortgage loans. They're super, super amazing financial tools to help you if you're not in a traditional way when you're with your income to get into housing, to find that house, to get that dream house that you wanted. You can still do it. So we're going to talk about the income side of it tonight. We're not going to get into the weeds about the credit and the assets and the collateral types. We're going to talk about the income piece because that's the non-qualified mortgage piece that I think there's a lot of misunderstandings and I want to shed some clarity on that. So first of all, let's talk about the bank statement loan and what we can't. Bank statement loans were around for a long time pre-mortgage meltdown and were really the self-employed's way to get lending. Well, the self-employed individual has a very interesting tax return. Let's just say that, okay? The self-employed individuals typically like to funnel things through their business taxes, that they pay for everything through their business, and what that does is then reduce their taxable income. So they may make a lot as their business is concerned. However, when it comes to their personal tax returns, they don't have a lot of income on that tax return. So the way that the mortgage industry has bridged that gap for that in particular borrower is we let your deposits do the talking, right? We can now say, hey, Mr. and Mrs. Self-employed borrower, if you can show me your tax returns, whether you're self-employed, right? You're not self-employed, sole proprietor, and you just have them coming into your personal tax return. Take two, have it coming into your personal bank statement, or if you are a corporation or what have you, and you have it through business bank statements, we can help you both ways. So how that works is we want to see that you've been self-employed for 2 full years, right? At least 2 years, and we could take a 12-month look back on your bank statements, or we could take a 24-month look back on your bank statements and average it out, right? So once we find that average, we can go out there and help you get pre-qualified for a purchase, or if you're already in the home and things have changed, particularly in COVID, maybe your overhead's been higher because you've been sanitizing your office space or your restaurant, or you've had to hire on more people, so your margin isn't there, so you're not showing as much income as you were the year prior, but you still show the money coming in because you're still doing those door dashes and all the takeouts that you can do, right? So this is a very flexible product for those individuals out there that are, I call it tax return challenged, but not deposits. They're still showing great business deposits, and it allows you to continue to stay in the real estate game. Super, super powerful program there. I clicked off, so I can't. There we go. Next one. There we go. So the simple math, what we do is we take that average, whether it's the 12-month average or the 24-month average, we add them all together, divide them by our 12 or 24-month denominator, and then we just apply a blanket ratio of 40%, right? 40%. So if your average bank statements come out to $10,000 a month, we're going to take $4,000 off the top for your business expenses, and we're going to credit you $6,000 a month towards your qualified income. So you can see how we're still meeting the qualified mortgage ability to repay. We're coming up with an ability to repay. Hey, we see this business has a 40% expense ratio and still can make this mortgage payment. That's how they're getting around it. Is it the same definition as Fannie and Freddie and FHA look for as far as documentation of income? No, not at all. Not at all. But that's why we're in the non-QM space. We have a little bit more flexibility. You just won't see these loans turn up in a REIT or a mutual fund or a retirement fund anywhere. They're going to be housed at the mortgage lenders that are making these loans. So still, it's opening up a whole market of individuals who wouldn't be able to qualify. Now they can get into housing. Super, super awesome. The next step that we do once we have those folks' tax return, or not tax returns, keep saying tax returns, bank statements. Once we have your bank statements and we get you pre-approved, you're offer ready and ready to go make those offers and win your deal. So changing gears a little bit from our self-employed folks, the next set of individuals are our asset-rich individuals. Assets can be used for your qualified income. And a lot of folks don't even know that. They don't even know that, hey, I've inherited $500,000. I've inherited $1 million. I have a trust fund of $1 million. I've done sporadic work here and there, but I would really love to buy a house. I can't because I don't have traditional income, right? Again, people have self-eliminated themselves, and I want to say, come on back, let's have a conversation and bring your assets to the table, and we can make that work. How that works is pretty awesome. Let's talk about the deposits that we can use. We can use trust funds. We can use money in your checking and savings account, stocks and mutual funds. Vested, and this is vestings in retirement. So it's got to be your vested amount. If you have a retirement account that, let's say you have a $100,000 account balance, but your vested portion is only $50,000, that's all the asset that we can use. We can only use the vested amount. So yeah, let's talk money. There you go, Yan. Let's talk lots and lots of money. So assets can be utilized to show your income. Also, business accounts. Business accounts can be utilized. One little quick caveat on business accounts. If you're in business with multiple partners, your percentage of ownership in that business is what we can use as far as the assets. So let's say there's 2 people in the company. You're on it. They're on it. You're 50-50 owners. And there's $100,000 worth of assets in the bank for the business bank account. We can only use 50 because that's your 50%. We can't use the 100% of the asset. If you're 100% owner of your business or a sole proprietor, we can totally use your business assets and your business accounts. And then certificates of deposit. One that I totally forgot to mention on this now that I see it, it's so flexible that if you have publicly traded stocks in a foreign country that are publicly traded, we can still use those. It's awesome. So a couple ratios to keep in mind when thinking about asset depletion. What the big ratio is, you have to have more assets than the mortgage balance. That's the number one ratio. So if you're looking at going out and buying a house and the mortgage is going to be $600,000, you have to have at least $600,000 in the bank accounts. Again, they could be vested across stocks, they could be in mutual funds, they could be in your retirement account. As long as we can pool all those assets together and they're over the loan amount that you're trying to lend on, you're eligible. Now, credit, again, we're not talking about credit and we're not talking about down payments and we're not talking about collaterals tonight. I just want to help everybody understand from an income perspective, there are extra options if you don't have traditional sources of income. So definitely, it's still worth a call to me. I'd love to help you out. If not, call your mortgage lenders. I want you guys to know, I want to empower more people into real estate because I'm going to get really passionate next week and talk about the power of real estate and how it changes lives, because it's a very deep core thing and it's something that we're not taught. The more people that I talk to about the power of real estate, it starts getting those wheels turning and it starts getting them thinking in a new direction because it's a powerful tool. So let's talk about our third. And I told you, I saved the best for last. Here we are at what I think is one of the most powerful products that you as a real estate investor, if you're changing that mindset from, oh, I'm going to rent, I'm going to just own my owner-occupied house and continue to work at my job, and hopefully at the end of 20, 30 years, I'll be able to retire. That would be great. If you want to take the bull by the horns and get after it and start investing in real estate, guess what? There's a loan for the investors, and it's my favorite. It is the debt service coverage ratio approach to real estate. This is a very common approach, and not common, it's the standard approach that commercial real estate works with. And it's been brought into, it was trying to be pulled into the residential world, so the 1 to 4 units. It was trying to be pulled into that residential world right before the mortgage meltdown happened. And then it kind of evaporated there for a little bit. And now it's back full force. How this works and what income we're using to qualify this mortgage is the rent on the property, right? So could we all agree that if the rent on the property is enough to pay the mortgage, that's a good loan? I think it is. I think it's a great loan. So here's how it works. Oops, I keep clicking. I'm going to get used to this. I got to click back onto the slideshow, otherwise it doesn't progress. In the world of traditional mortgages, we look at your debt to income ratio. How much income do you have versus how much debt you have? That's the same thing with debt service coverage ratio. We say, hey, the house has taxes, insurance, mortgage payment of X. Does the rent cover that? Yes or no? And if it's a yes, it covers it. You're good to go. Let's get it done. And that's how we find and meet the ability to repay for these investment properties. So when you're thinking of, well, how is this similar or how is it different? The similarity is debt to income ratio is just the property's debt service coverage ratio. So we're really looking at very similar compounds and arithmetic, but instead of looking at job and your credit report, we're looking at the mortgage payment versus the rent. And that's simple. That's awesome. So we do not even disclose. This is where it gets super good for all of those folks that want to continue to invest in property. We don't disclose your current employment. We don't care. We don't care about your current employment because, again, debt service ratio is all about that property and not about your income. So that's where the power lies. It has to be an investment property. This is not for your owner-occupieds. This is not for your second homes. this has to be an investment property. So you must have a mortgage. When these mortgages came back out, the debt service coverage ratio mortgages came back out. I'll be honest with you, there was a couple folks that were wise to the game and like, oh, hey, I rent. I don't have enough income to buy that house. So I'll say it's an investment property and just use the rent to pay for it. And that's how I'll get into it. That got squelched. You must have a mortgage currently to be able to qualify for this loan. So, and a little bit different, we were talking about in the qualified mortgages that they don't have things like interest only. They don't have things like negative amortization. A qualified mortgage can't have a prepayment penalty. In the world of debt service coverage ratio, prepayment penalties are more common. You can buy them out by taking a higher interest rate or paying discount points. You can actually eliminate them if you're not going to hold that property for 3 or 5 years, depending on the lender that you choose and the underwriter that we choose. So that's definitely something to talk about as far as, well, does that prepayment penalty really affect me or not? So it's all dependent on your investment strategy long term. And if it's going to be a shorter term investment property, then you may want to look at buying that out. So when we look at this program, what this program does, it allows the investor not to be codependent on employment. Here's what happens a lot with our fine investor friends. They've made a good living, that they're ready to give up the corporate lifestyle. They've saved up a little bit of money. They've got a nice nest egg and enough to go out and buy a couple maybe flips or rental properties and buy and holds, and all of a sudden something bad happens at the office, one TPS report too many, and they like throw up their hands and say, I'm out, I'm done, I don't want to do whatever I'm doing anymore. I'm going to go become a real estate investor. And then guess what? They don't have their W-2. They don't have their pay stub. They're no longer Fannie, Freddie, FHA customers. They're done, right? So we have to look in alternative places for their mortgage lending. And the debt service coverage ratio for those investors that don't have traditional income, awesome way to get that next door to continue to build a real estate portfolio. So that is why I think it's one of the most powerful tools out there as far as debt service coverage ratio and alternative ability to repay mortgages, because it allows you to get through there. So that is it. If we have any questions out there, please feel free to dump them in the chat and let me know what I can shed some light on. But from the ability to repay standard, I just wanted to share that tonight. That's what was on my mind last week, because I was helping some folks work through that and continue to buy more and more properties. So if you have any questions on it, let me know. In closing, we're going to talk about next week. Number one, I want you guys to want you to share, and feel free to subscribe to the YouTube channel. We're going to continue to build momentum and bring some awesome shows to you in the future. But next week's going to be a little bit special for me. Next week is the power of real estate and why real estate changes people's lives. And this is no big auditorium guru like let's go rah rah rah. This is really, let's talk about the numbers and where we've come in the last 2-3 decades as far as what the housing prices have gone, where they've gone to, what the appreciation is. I'm hearing a lot of folks talk about, well, the real estate market is overheated and it's a bubble. The stock market is overheated and it's a bubble. And I want to get back to the fundamentals of talking about the power of real estate and why we're not in a bubble, because it's my firm belief. And I'll show you the charts next week. I'll show you the graphs, and I'll show you the power of real estate and how it can change your life. But it's not it's not a simple conversation. There's a lot of economics in there. There's a lot of power in there. So if you're ready to take that financial prowess to the next level, please join us next week where we talk about the power of real estate and break out the graphs. And then you can be powerful in the next conversation with your fellow, well, I always like to use the barbecue analogy. Like, hey, next time you're at the barbecue at the neighborhood barbecue, but not a lot of people are getting neighborhood barbecues going right now. Hopefully, I heard we're getting into phase 3. Hopefully, we can have some more neighborhood barbecues so you're ready for the neighborhood barbecue or the neighborhood Zoom call. And when somebody chimes in and says, "Oh, the real estate market, it's overheated, it's a bubble, it's going to fall apart," I'd love to show you guys the powerful evidence why it's not. So, in closing, just saw it. Yes, it will be real talk. You're very welcome, Jamie. It will be real talk about the power of real estate and how it's going to change your life and how we can help more people change their thinking and buy more real estate. So talk soon. If you guys have any questions, comments, throw them in the chat. We'll catch you next Thursday at 7 p.m. here on Mortgage Firm and Treehouse. Take care. Have a great night.